In just over a year, the retailer has flooded social feeds with curious consumers.
Is Temu a scam?
She's a serial Temu user.
Shein is known for $2 t-shirts and $7 pants, with prices even lower than its competitors.
China was about to take over online shopping in America. Temu and Shein were not just popular, they were taking over the market. Look at this chart. It shows how Temu kept growing and even challenged Amazon. In 2023, both apps were almost always in the top 3 most downloaded shopping apps in the US. Temu even hit #1 many times on the App Store, and Shein was right behind. At one point, Temu had over 100 million downloads in the US, and it was spending more money on ads than almost any other retailer, except Amazon. People were crazy about these apps. Look at this beautiful dress from Shein, people would say. Everyone was telling their friends, always check Shein before you buy anything from anywhere else.
Shein is a global online on-demand e-commerce company, a profitable growth company at scale.
Around the same time, Temu, that's PDD's business outside of China, started taking off, especially in the US.
Shein was making huge money, around $45 billion a year, by selling thousands of new fashion styles every single day. Many of these styles were copied quickly from TikTok trends. You could see them everywhere, in your social media feed, your group chats, and even on your doorstep within a few days. Temu wasn't far behind. They sold everything, from socks to power drills, with prices so cheap it almost felt illegal. And in a way, it almost was. They used a tax loophole to skip import taxes, bringing in super cheap products from China. On top of that, they spent billions on ads and discounts to win over customers. And it worked. Big time. But hold on. Things are about to take a wild turn.
Topping tonight's money headlines, Shein and Temu are seeing a drop in shopper activity here in the U.S. The plunge comes amid recent tariffs on Chinese imports.
Last Tuesday, the US-listed stock of the bargain shopping platform Temu tumbled over 13%. This sharp decline followed the company's disclosure that its profit for the first quarter had nearly halved, plunging close to a 50% loss. Executives pointed to new US trade restrictions, most notably the cancellation of the import duty exemption for low-value packages, as a key driver intensifying pressure on its business at home. Ever wonder how tough the e-commerce battlefield really is for giants? And how are we really impacting it? Stick to the end to know why. You've probably noticed fewer people browsing Shein and Temu in the US these days, and it's no accident. A surge in tariffs on Chinese imports has made once rock-bottom prices a thing of the past. For years, Chinese firms quietly dominated the US bargain market, offering dirt-cheap goods, shipping them direct from China under a loophole, and effectively outselling American retailers. But with that loophole gone and tariffs soaring, the tables have turned. Now Temu is losing nearly half of its US users in just a few months. Shein has also seen shopper activity slide, even across its huge audience. So here's what really happened. Chinese companies like Shein and Temu were using a little-known trade rule called the Minimis loophole. Basically, it allowed any product under $800 to be shipped straight to a US customer without paying any import taxes or going through full customs checks. Sounds harmless, right? But here's the catch. These companies started flooding the US with millions of ultra-cheap packages every single day. Ever since the US cracked down on Chinese imports and shut down a tax loophole that let these retailers dodge costs and beat out the competition, things have taken a sharp turn. According to the Financial Times, Temu's monthly active users in the US have plunged by over 50% in just a few months, dropping from over 80 million down to around 40 million. Shein didn't escape the damage either. Its US user count fell about 12%, sliding to 41.4 million. Not as dramatic as Temu, but still a serious hit. Both companies had built empires off ultra-low prices and constant social media ads. That strategy helped them dominate the online shopping scene fast. Now, reports say they're eyeing a public listing in Hong Kong instead. Yeah, you can bet the Chinese Communist Party won't be too happy about this video, and chances are their little army of bots will do everything they can to push it down. But here's the cool part. You can help push back just by tapping that like button. Seriously, it makes a huge difference. Thanks a ton. It all kicked off with a simple but powerful concept: undercut everyone else on price. Temu hit the scene in September 2022, backed by China's PDD Holdings. But instead of going the usual route with warehouses in the US and local supply chains, Temu flipped the script. They used what's called a factory-to-doorstep approach. No middlemen, no wholesalers, no warehouses in the States. Just a direct line from Chinese factories straight to American buyers. And that changed everything. Why? Because cutting out all those layers meant they could slash costs like crazy. No storage fees, no US distributors, no markups. Just super cheap prices. And American shoppers loved it. By the end of 2023, Temu wasn't just some random app. It was everywhere. With over 100 million users in the US alone and nearly 500 million visits to its site each month, it exploded onto the scene. You couldn't scroll Instagram or watch a YouTube video without seeing a Temu ad. Their marketing budget? Insane. They were outspending everyone. And it worked. Temu shot straight to the top of the US App Store in 2023 and stayed there into early 2024. Now, Shein, well, they were already a beast. Launched back in 2008, Shein was the undisputed heavyweight of fast fashion long before Temu ever showed up. Instead of dropping new collections each season, Shein was using real-time data to roll out fresh styles daily. Everything shipped directly from Chinese factories to customers around the world. By 2023, Shein was the biggest online-only fashion brand on the planet. In the US, it had a massive grip on the Gen Z market, dominating fast fashion sales and topping app download charts 2 years in a row. Just like many apps from China, Shein is packed with deals and discounts designed to get you hooked and keep you coming back for more. In fact, it's almost guaranteed you'll get at least 3 special offers the first time you open the app, making it super tempting to keep shopping. But here's the twist. Both of these companies had a secret weapon, a quiet little loophole that gave them a huge edge over American competitors. It was called the Minimis rule, and it changed the game. And just when you thought the crackdown couldn't get any tougher, boom, another update. To reinforce the goals behind Executive Order 14257, the White House pushed the penalties even further. Initially, the import duty had jumped from 30% to 90% back in early April 2025. But just a week later, on April 9th, that rate was cranked up again to a massive 120%. This latest increase specifically targets low-cost imports that have ties to China's synthetic opioid supply chain. The goal? Hit back hard at the flow of fentanyl-related goods and close every loophole being exploited. Temu and Shein turned this provision into their business model. By shipping cheap goods in millions of small packages directly from Chinese factories to US consumers, they avoided tariffs and warehousing costs. This strategy allowed them to offer ultra-low prices, $3 t-shirts, $2 earrings, $5 sneakers, making them highly attractive to American shoppers. The scale of this practice was enormous. In 2024, approximately 1.36 billion shipments entered the US under the de minimis rule, with a total estimated value of about $66 billion. Nearly half of these packages originated from China or Hong Kong, with Temu and Shein accounting for as much as 30% of all daily packages entering under this exemption. However, this loophole has now been closed. In May 2025, President Trump announced the termination of the de minimis trade exemption for Chinese and Hong Kong imports. This change has led to increased tariffs and customs scrutiny, significantly impacting the business models of companies like Temu and Shein. You might be wondering, why didn't US retailers replicate Shein and Temu's strategy of shipping millions of tiny packages? The answer lies in the resources these Chinese companies had access to. They leveraged China's ultra-cheap labor, subsidized shipping, and direct factory connections, advantages that most US sellers couldn't match. Without these resources, American businesses couldn't afford to ship millions of small packages profitably. This disparity led US retail groups to push hard in Washington to close the loophole. The influx of inexpensive Chinese imports severely impacted American manufacturing, particularly the textile and clothing industries. The consequences were significant. By September 2024, 18 US textile plants had shut down. By May 2025, that number had risen to 28. Reports indicated that these closures were directly linked to the surge of low-cost clothing from China, much of it sold through platforms like Shein and Temu. In 2024 alone, Chinese apparel imports to the US totaled $16.7 billion, accounting for 21% of all US apparel imports. This influx of cheap goods made it increasingly difficult for American manufacturers to compete, leading to widespread closures and a significant shift in the retail landscape. In April 2025, President Trump signed an executive order eliminating the de minimis exemption for low-value imports from China and Hong Kong. This change, effective May 2, 2025, required all shipments from these regions, regardless of value, to undergo customs procedures and pay duties. Previously, goods valued at $800 or less could enter the US duty-free, a loophole exploited by companies like Shein and Temu. Under the new policy, small packages delivered by the US Postal Service faced an immediate 30% tariff or a minimum $25 fee, which increased to $50 in June. Shipments by private carriers like UPS or FedEx were subject to full import duties, which could reach up to 145% for certain categories of Chinese goods. This policy shift aimed to level the playing field for US businesses by ensuring that foreign sellers adhered to the same import regulations. It also addressed concerns about consumer safety and the integrity of the US market. China fooled the US for years and was winning right in America's backyard. But not anymore. The tables have turned. The fight back has begun. But do you really think China is going to stop here? I doubt it. In fact, they're already cooking up a brand new strategy to exploit fresh loopholes. That's a whole other story. And if you want us to break it all down in the next video, drop your thoughts in the comments below.